Hello, ladies and gentlemen. This is Vinny, or Vincent, however you may know me, and this is going to be my second stock video, except my first video kind of went over my entry model, and I kind of figured that if somebody's trying to get into this field, especially my friends and family who keep asking me questions about where to learn and everything, I figured I might as well just make like an introductory video and kind of speed run you guys to get to where you need to be. And I'm not going to waste too much of your time. I'm going to get into it, and so that you don't spend too long learning. But if you have any questions later on, just feel free to reach out or comment down below, and I'll do my best to answer your questions. And so this is going to be a bit fast paced, so make sure you get your pen and paper out and take some really good notes and write down your questions. So I'm gonna start this off as if you guys don't know anything about trading at all, and if you don't know anything about trading, you kind of gotta get to know the basics. And so basically in the stock market you have buyers and sellers, and buyers and sellers, they influence whether the price goes up or down. When people buy the stock, the price of the stock goes up, and when people sell the price of the stocks go down. And here's some basic terminology. So if you want to make money while the stock price goes up, you are going to enter a position called a long. And if you want to make money when the stock price goes down, it's called a short. And you can do research on these, and I'm not going to go too much in depth about it, but this is the terminology. You go long or short. And when you go long, there's a terminology for that too. It's called bullish. And then when you want to go short, it's called bearish. I don't really know why they chose these terms, but yeah, that's just what we do. Terminology. Alright, delete this, on to the next. So now we get into other basics. I'm sure whenever you're looking at stocks, you're not used to looking at something like this. When you think of stocks, I'm sure you think of something like this. Price goes up, it goes down, it goes up, it goes down. It looks like a heart rate monitor, but this doesn't really give you too much information. So what we have to start off with is finding a different way to interpret this information. So these are called candlesticks, and this is called the candlestick chart. And so to be able to read these candlesticks, I do have them colored differently. So the white candles are green and the black candles are red. Now let me scroll over here. I can show you. So basically right here, how you read it is a green candle right here. This is the opening price of the candle. So when you see one singular candle, hold on, let me explain it like this. Right here at the top left, these are the different time frames. So this is the 1 minute time frame, 2 minute, 3 minute, etc. And you can choose to select different time frames of your choice. So since I'm on the 1 minute time frame, every one of these candles represent 1 minute. So if I go to the 5 minute, that means each one of these candles are 5 minutes. So if I go to the daily, each one of these candles are 1 day. And there's a whole bunch of candles. So that is the gist of the candles, but how you actually start to read them is you start to interpret it like this. Right where my cursor is, this is the opening price. So every single minute a new candle opens, since I'm on the 1 minute chart. So every single minute, wherever the price is, that instant it opens, it's the opening price. And then let's say price of it goes up. The price goes up. So the price is right here, and then later on it goes up and it goes back down. This is the highest points it's ever been, the highest price it's been within that minute, and this is the lowest price it's been within that minute. And this is the price it closed at after the minute was up. So this is called the body of the candle, because you can think of it as wax. Like imagine a candle with wax, and then the little thing sticking out of it is the thing that you set on fire. This is called the wick. This is the candle. This is the candle. This is the candlestick body, and this is the wick. Very simple terminology. Oh, I hope I'm not like undermining it, but this is basically it. If you open at $5, you close at $10, you've made profit in that minute. So the opposite is basically when you open at $10 and you close at $5, you've lost $5. But the highest you ever went is up here, and the lowest you ever went was down here. So how this would look in real time would look something very similar to this. You open right here, right? And then price shoots up like this. Or let's just say it shoots up to right here. And then it goes down like this. You've created that top wick. What about the bottom wick? Imagine these are your candles. And your opening price is right here. So this is how the candles print in real time. This is where it opens, and then a couple of seconds later, price starts to move. Let's say it shoots down. Price shot down, the candle is red. Now price would shoot up, the candle is green. But you notice how we set in that bottom wick. Now price begins to creep down a little bit, and then boom, the 1 minute is up, whatever time frame you're on, and then that is your candle. It created the bottom wick and the top wick. So now the importance of this comes to be when you start using it on higher time frames, because you're like, so what if it opens right here, closes down here, opens right here, closes down here, it went that high up here, and then this is the lowest it went, etc. What is the importance? Well, if you start to understand how the candle was formed, you can go on the higher time frame, like the 1 hour, or the 4 hour, or the daily, or even the weekly, but mostly the 4 hour and the daily. Now the reason why it's important is because if you don't know where price wants to go within that day, for example, this represents one entire day. So whenever you're trading and you are in longs, then you can trade the entire daily candle, because you open right here, you drop this low. So if you find your entry somewhere within this bottom wick, you can hold it all the way to here, and all the way up, and it'll go all the way down, and it'll close right there. So in a way, you can learn to catch the entire daily move. You can catch the whole move of the entire day. That is the importance of this, and this concept is called open high low close if you want to study this in your own time, and open low high close. So how the red candle is formed, it opens up here, it goes high, it goes low, and then it closes. So that sequence right here is called open high low close, and then this sequence over here is called open low high close. So again, I'll do it real quick. It opens. Okay, that was weird. It opens down here, it goes low, it goes high, and then it closes, creating a green candle. So you can predict whether, or you can determine whether or not the daily candle will be green or red. You can catch the entire move. So what I basically taught you was a high time frame power of 3, or another concept called AMD or power 3. AMD / PO3. I know this is all probably super what do you call it, overwhelming, but I'm giving you all the knowledge in one place, and I'm speedrunning it for you. So AMD PO3, it is basically, what it is a concept of how price moves. You open here, right? You go low, you go high, and then you close. This is your open high low close, but on a higher time frame. So if you can find your entry within the wick, so let me draw this for you. This will give you a better visualization of what I'm talking about, of the wick. So if you can find your entry somewhere down here for longs. And you can write this whole thing up. This is where price is so far. And then at the end of the day, price will have to go back down like this and then close right here. And what this would create is your open, high, low, close. I mean open, low, high, close. And it'll create a big green candle just like that. And then the opposite. What the opposite would look is just like this. Bearish power 3. You open right here, and then you manipulate up, and then you close down here. So then this would be your red. Be a very long red wick all the way to the highest point it went, and then you would make a bottom wick later on and then go back up. So it will look like this. Boom and boom. Stop right there. This is your open, high, low, close. This is how the daily candle is made. So I'm gonna delete this now. We just covered open, low, high, close, and power of 3. And basically the power of 3 has 3 moves, and those moves are called AMD. AMD stands for accumulation, manipulation, distribution, and it happens in that specific sequence: A, M, and D. Now before I deleted that other photo, let me show you this. This had A, M, D. Now realize that this AMD is upside down. These two are completely separate and different from each other, where the manipulation is up here and it reverses the other way, and the manipulation is down here and it reverses the other way. So in order for you to catch your trade at the bottom wick or at the top wick of the higher time frame candle, you would just need to find your entry within the manipulation. It's really that simple. And once you can understand this higher time frame narrative of where price will be moving, you'll be able to catch the daily move. And yeah, so you just memorize this chart. Make sure you take good notes of it. Accumulation is basically consolidation, and consolidation, if you don't know what that means, that just means price is going sideways. Now price breaks out into a level, a key level, and then it would reverse the other way. That is power 3. That is how you trade power 3. So you don't want to trade this. You want to wait for this manipulation. And then you would find your entry, and then you would take that entry right here for the distribution, and you would write this thing up. So that is how you trade PO3. And now you just need to work on your entry model. Now I'm gonna delete all this, and then so now about entry models. Now you have to start learning about candle formations and like candle patterns. So as you can see, we have some terminology called fair value gap. Fair value gap in trading is basically a 3 candle pattern where you have this candle, this candle, this candle, except this middle candle right here, it's called expanding. So it expands, like you see the arrows right here. It expands large enough to make to have a body. Like can you see the body of the candle right here? This body has a gap between these 2 wicks. So it's the wick from this candle, and the wick from this candle, and this middle candle expanded enough to make a gap. This would be your fair value gap. Same thing over here. This middle candle is large enough, it expanded enough to make a gap between this wick and between this wick. This is your fair value gap. Sometimes if you have long wicks like this, there is no fair value gap because there is no gap of a body between these 2, because yeah, I mean, I think you can kind of tell. show you real quick. There's 3 candles, 1, 2, 3. There is a fair value gap right here, just like that. That gap. But where there is not a fair value gap would be, let's see, here. These 3 candles. This one, this one, this one. No fair value gap, but there is one right here. Right? So once you can identify fair value gaps, you can probably get an indicator to help you identify them. You can look at this one, fair value gap by Lux Algo. It is pretty good. But once you understand fair value gap, you get to understand some more concepts. So there's this other concept called inverse fair value gap. Basically the core concept behind these patterns on why they form and everything is because if you look at this downward trend, right, that means there's a whole bunch of sellers that came through and we push price down, and right here we push price down fast. So this is, let's say this is the 1 minute chart, 1 minute, and then so this is 5 minutes in total because there's 5 candles. In 3 minutes, from this minute, and this minute, right here we pushed far enough to create a space between this bottom wick and this top wick of the 3rd candle, creating this imbalance, quotation marks, imbalance. Basically what it is an imbalance, imbalance in sellers, because right here there's more sellers in the market than buyers. That's why price moved down. But when you inverse it and the buyers step in and undo all of the sellers' hard work to push the price down, it inverses trend. It's not the best sign. It's not the best sign of inversing a trend, but it signifies an inverse when you pair it with other confluences. So basically over here, the trend is up, okay? You've created bullish fair value gap, but then you've inversed the gap. And now, how do you inverse a gap? You have to close outside of this box. You see this box created from this wick to wick right here? You have to close outside of it. That. So, same thing right here. In order to inverse it fully, you have to close outside of the square. I know I'm kind of speeding past this and I'm kind of tripping over my words just a little bit, but I hope I explained it good enough to you to where you understand open, high, low, close, power 3, AMD, and fair value gaps and inverse fair value gaps. So then now I'm gonna show you a good example of power of 3. Let's see. I'm not trying to cherry pick, but there's a theory in the market where everything is power 3. So, for example, this spot that I marked green, this could be accumulation where we consolidate a whole bunch, and then this could be the manipulation, and this could be the distribution. And you define your entry right here for shorts, targeting that. But the key thing is you need to manipulate into something. So let me teach you about this. There's this thing in the market called session profiles. And it's a very like a fancy word, but it's you're breaking up the market into 3 sections: London, Asia, and New York. And New York has 3 sessions within it. It's broken into the AM session, and then the PM, and also lunch. And so basically what these do is they're called kill zones. And what they do is they mark the times whenever the market is usually most active. This is when a lot of people wake up, a lot of people start trading, a lot of things open and everything. This is when the most people start trading, so price is going to move a lot faster. So whenever you tap into these highs within these kill zones, for example, like this previous kill zone right here, you can see this right here, Asia high. You see this blue box, how it stops right here? This is the end of the kill zone, and this is the highest that we went within that time. What happened right here was that we accumulated, I guess you could say this will be a high time frame accumulation. Like literally PO3 is everywhere. It's just how you interpret it. This would be your manipulation, where you sweep these highs, right? And then you would take the shorts off of the distribution. Okay, so there is also power of 3 inside of here. And now I might start losing you here because it just sounds like a whole bunch of jargon and that everything is everything, but that's like the coolest part about trading. And so if you take a look at this right here could be seen as accumulation, right? Or even like right here, this could be seen as accumulation. And then what happens is you manipulate down right here. And then you can find the distribution upwards into Asia highs. Let's see, I'm gonna see something real quick. So technically, normally when you manipulate like this, you want to see yourself manipulate into something. That's like kind of like one of the most important parts. So what we manipulated into is probably this 5-minute inverse fair value gap right here, right there. But maybe we have something on a higher time frame, like this 15-minute fair value gap, right? That we wicked into right here. Or it could be even higher, like this 1 hour or hour. But this is basically what trading is. You just kind of like try to find these patterns in the market, and they happen all the time. So basically what I taught you is AMD. Let's see, I do have a couple more things I need to teach you, like SMT. So this is what price does all the time, right? It accumulates, manipulates, distributes. This is AMD. And then here is, let's say you're watching 2 charts. I'm gonna separate it like this. You're watching NASDAQ and you're watching ES. I'm so sorry if this is like the worst video ever. I'm not gonna lie. If it is, I'll rework it and make better videos. But this is NASDAQ and this is ES, the S&P 500. So what the correlation between these two is that they normally are very similar to each other. They're like brother and sister. Now the only difference is sometimes they don't do the same things. And so let's say NASDAQ has price like this, right? And then we take out this high like that, and then we dump like this, right? We took out this high right here, but then on ES we have that same high like this, and then we go like this, but then we never take it out and we just dump. So now, don't you see that like they kind of like are acting a little different? Like, isn't ES supposed to shoot up here too? So then what does this mean? This means that somebody is manipulating the market, which is part of AMD. This is your manipulation. So if you can identify that, hey, NASDAQ took out this high, but ES did not take out that high, this is called an SMT. How you would draw it, you draw it like this, from that high to that high, and from that high to this high. Now, if you watch my first video I made, I talked about something called CVD SMT, and it's essentially the same concept except with order flow. Order flow, if you don't know what that is, it's essentially just seeing the orders flow in and out of the market, and then you can have the same concept of the SMTs. So this right here, this SMT, shows you that this is the manipulation. So if this is the manipulation, then this is the accumulation, which is green. This is the manipulation, which is red. And this is the distribution, which is blue. So then what you would do is you would find your entry right there and put your stops at that high. This is AMD all over again, except you have an SMT to help you show you even more. Same thing right here. Accumulation. I'll just do this. This is your manipulation. Accumulation. And then distribution. And then you get the point. And so they have these terminologies called leading and lagging. So what this means is one of these will be leading and one of them would be lagging. And if you could take a guess in like 5 seconds, then if you guess that this one was leading, you're correct. This one was leading. I'm not going to spell that out. But this is leading because we took out the high with this. Now ES is lagging because in order to get rid of this SMT, it has to shoot up more past this high. But since it didn't, it's lagging behind. This is the leading instrument. This is the lagging instrument. Some people prefer to take trades on the leading or the lagging. It's really up to you. What I personally prefer to do is take trades off of the leading instrument because you can get a better entry off of it. I'm not gonna explain that in this video, but yeah. So basically, if you have these highs and lows, you can imagine that sometimes you will create an SMT where NASDAQ will take out this high and ES won't take out that high. And so this indicator, the kill zones indicator, shows that you took out this low, and then that you probably like these are literally the highs and lows that you could take out, and it doesn't even have to be the kill zones highs and lows for there to be an SMT. There can even be a minuscule SMT from here to here, from here to here. I'm not gonna really try to look for one because that is quite a bit of work. But like for example, there is one right here. On the 1 minute chart, there is an SMT. If you see right here on the ES, we have this high right here, and we took it out with this black candle. Now on the NASDAQ, we have that same high, but we failed to take it out. You see that? That is your SMT. So it's small stuff like this that you gotta pick up and learn. but this is just a general overview of it. I don't expect you to learn and understand just from this video alone, but there are plenty of resources online for you to learn from. What I hope you took away from this was ICT kill zones and pivots, AMD Power 3, how to read a candlestick chart, the importance of the candlestick on a higher time frame and how you could trade it. Obviously you're not fully there yet. You still need to work on an entry model and how to figure out that entry model, but so far you've already learned quite a bit, and this is part of where you start to branch off into your own research, and I hope that this kind of made things easier for you to start learning. And if you have any questions, feel free to comment and let me know.